Good morning, folks. It's Friday on planet Earth. Let's look at the charts. This is gold in the daily time frame. Gold's looking just fine after its last beat down, working on a rally, pushing up into resistance. Strong action, in my opinion. Given everything else that's going on in the markets, what I see here is that gold is demonstrating that it is a safe haven asset. Of course, it's been real money for 5,000 plus years. Obviously that's personal opinion, but there are certainly other opinions. Anyway, gold is looking just fine. I would suggest that with everything going on in the equity markets and the bond markets, that gold, the precious metals, are demonstrating that they are safe haven assets. And other assets that people would like to believe are safe haven are demonstrating that they are not safe haven assets. We'll get to Bitcoin here in a minute. So here's silver in the daily time frame, sitting down here in support, same thing. We got a big beat down and now we're getting sideways consolidation with a lot of volatility. In my opinion, silver is the key to the financial system. When they lose, well, not that it's the key, it's the focal point of where the financial markets fall apart. If the price of silver breaks higher, it's all over, in my opinion, and we won't not going to spend a lot of time dwelling on that. So if you don't have physical silver, folks, I suggest you get some while it's available. The mining stocks, they're following the metals, sideways bumping, maintaining this support level. This is the weekly time frame of GDXG, just down here bumping sideways, following the action in the metals. GDXJ in the daily, nothing exciting, sitting on support. Stocks, mining stocks are waiting for the metals to do something decisive. And of course, they're fighting the headwind of the overall equity markets, which are, is falling apart is that melodramatic to say that the equity markets are falling apart? I don't think so, but again, that's personal opinion. Here's dollar in the daily time frame. Obviously, we got a big pullback. So for whatever reason, investors, holders of the US dollar have decided to dump them. And so that's what we're seeing here is a big dump of US dollars. MACD headed down into bear mode on a sell signal, energy very low. So weakness in the dollar is obviously helping the precious metal. Let's see, here's Bitcoin. So Bitcoin, remember this was the ETF. And so this is when the insiders flipped their Bitcoin shares to the retail investors as purchasers of the ETF. And here we are, almost 50% lower in 3 months. So anybody that bought that ETF is not a happy camper at this point. Based on volume, some of those investors decided this was capitulation point. Don't care how much money I've lost, get me out of this investment, quote unquote investment. And so anyway, we get a big spike in volume as investors capitulate, and then we get a big spike of buying. And so some group of investors came in and they bought this low. Well, coincidentally, we've got, I think it's ARK just announced they're gonna open a Bitcoin ETF. And so what do you bet me that a whole bunch of this Bitcoin was bought by ARK and anybody else that thinks they need to start a Bitcoin ETF, and they'll engineer some kind of short covering rally. They'll run the price of Bitcoin back up here somewhere. They'll open their ETF. They'll flip those Bitcoin to the retail trade, and then Bitcoin will lose another 50%. But, what the heck do I know? I'm just reading the tea leaves. That doesn't look good. Some of the stocks yesterday had some dramatic action. Here we are, Facebook, Meta, Metaverse, Meta, who cares, whatever. What is that? That 25%, something like that. 26.4% Meta dropped in one day, lost two significant resistance levels, You know, maybe it bounces back up and is able to hold above that support level. Wouldn't appear to be the case. Let's drop down just out of curiosity. Yeah, see, that's the last hour, the markets yesterday. You can see that all it did was continue to sell off. So maybe we get a bounce today. It'd be interesting to watch that chart. So anyway, that's Metaverse. PayPal, similar. What did PayPal lose yesterday? So they only lost 6% yesterday, but again, significant loss of a resistance level going back, you know, a year and a half. So something going on in some of these name brand, that's Facebook again, name brand stocks. And then if we look at some of the market internals for the equity markets, this chart is showing us the number of stocks in the S&P 500 which are above their 200-day moving average. And so we can see we reached a peak back here in April of 21 and have been in a steady decline. Well, you could call that a steady decline. I'd call that falling apart. And so anyway, the internals of the market, the equity markets, are falling apart. I would suggest at this point, if you are an equity investor, if you have any significant amount of money in stocks, you might want to take a look at what's going on, broader picture than just the headline indexes. If you're only watching the headline indexes, you are being played. Those indexes are, I won't say that they are heavily manipulated. The Dow is certainly massaged, but just inherent in the way that those indexes are calculated, they paint a favorable picture of the equity markets. And if that is all you're paying attention to, you may not have an accurate picture of what's really going on in the equity markets. Look at market internals. The equity markets are falling apart. This is S&P 500 in the daily time frame, and what I see in the price action is a market that was collapsing. We got the plunge protection team. They started in 1987. We got the ESF, Stabilization Fund, Equity Stabilization Fund, going back all the way to 1934. Governments have been manipulating, managing the financial markets all the way back. I mean, just, probably forever. And so to think that this is natural action in the markets, I mean, it just isn't. So go do some research, folks. And so anyway, to my eye, this is a collapsing market. Plunge protection team did a stick save. This is a counter trend rally, in my opinion. This is not the start of a new rally to new all-time highs. This was a counter trend rally. And what we saw yesterday is that price is rolling back over. We'll see today whether price continues to roll over or if they're able to stage another stick save. Well, it won't really be a stick save today, but if they're able to push these markets any higher today. Of course, we've got the payroll report coming out, which is not expected to look good. That looks like a second copy of SPX. So anyway, my opinion, counter trend rally to the prior high. There's our prior low point. Sorry. Counter trend rally up to a potential support resistance level, and then a dramatic rollover. So, and we'll see what markets want to do today. Dow, similar story. Stick save, plunge protection team, counter trend rally that rolled over yesterday. What's that? 1.45%. SPX lost, what did it lose yesterday? 2.4%. Here's the NASDAQ, lost 4.2%. So big thing, big drop in NASDAQ yesterday. And again, stick save, plunge protection team, counter trend rally that rolled over yesterday. That is one ugly market. Psychology in the equity markets, and in particular psychology when markets are falling. And so as human beings, our lizard brains come into action. And unfortunately for us as investors and traders, our default brain wiring is about 180 degrees opposite of what it takes to make money in the financial markets. And so one of the things that kicks in when markets start doing this is that investors say, well, I'll wait for it to come back and then I'll get out. Well, just potential, folks. And again, I'm just reading the tea leaves, If you're waiting for it to come back, that may have been your opportunity and it ain't coming back again. And so, you never know. There's no way to tell. I just suggest that if you were waiting for the market to come back, that may not be a great strategy. One of my relatives in the .com, 1999, 2000, they had a tech stock that they rode, bought it at, I don't know what, I think they paid $12 for it. It ballooned all the way up to $105 a share. And they finally sold it several years later for $5 a share. So held it while it spiked up to 105 and then held it while it dropped a full $100 a share. So, psychology is a hard thing to deal with when you're losing money. Just to take a wider look, this is Russell 2000, and we can see same thing. Collapsing market, not as obvious that we got a stick save, although clearly there's a lot of volatility in there. We got a 38% Fibonacci counter trend retracement followed by a rollover. 1.9% drop yesterday. Again, that's not a healthy market in my opinion. Let's keep rolling here. This is the big story, in my opinion, folks. If you're not paying attention to inflation, you should be paying attention to inflation. So these are the official government numbers telling us that inflation is currently at 7%. And look at how quickly it spiked from, the bullshit that they've been telling us for years, that inflation is basically non-existent. 2% they were hoping to get 2%. And now we've spiked to 7. Well, those are the official numbers. If we look at this is John Williams, shadowstats.com. Highly recommend this gentleman's work. So he maintains inflation indexes using the methodology that the BLS, the government, the Bureau of Lying Statistics, Mr. Williams uses their methodology from 1980 to calculate the real inflation, or what I believe is closer to real inflation. And we can see this is here in the blue. So government is telling us inflation is 7%. Reality, based on BLS 1980 methodology, is 15%, and certainly see people talking about higher. You can look at other ways of measuring inflation, and they are higher than 15%. So inflation expectations, obviously investors are starting to expect inflation, and they're getting it in spades. This is the 10-year Treasury note in the weekly time frame. This is the chart that I, normally watch to keep an eye on interest rates. In recent weeks, last couple of months, there has been more interesting action. That's the 10-year again. In the shorter end of the bonds, bills, and notes, here's the 1 year, and we can see that that's almost a parabolic curve. I mean, that is a market on the verge of parabolic action. If you're not quite ready to call that parabolic, it's darn close. And so anyway, dramatic rise in interest rates on the short term, on the short end of the curve, the short time frame end of the curve. And one of the easy ways to understand why that is going on, if we go back and we look at inflation rate, whether you want to believe that it's 7% or 15%, if that's the inflation rate, why would I go put my money, why would I go buy a bond for 10 years that's paying less than 2%? Let's see, inflation 7%, I can earn 2% on a bond. Doesn't that mean I locked in a 5% loss? Well, of course it does, folks. So you can lose 5+ % on 10-year note. Here on the 1-year note, you can lose, well, that's guaranteed loss of more than 6% based on government numbers, or 14% based on John Williams numbers. 2-year, same thing. Okay, so you can lock in a loss of 6%. 5-year, you can lock in a loss of, what's that? 5%, 4.5%. Anyway, bonds offer nothing but guaranteed losses at that point, at this point. And in my opinion, when this becomes obvious to investors, the inflation is higher than the yields available on bonds, investors change their decisions about where they want to put their money, because it doesn't make any sense to buy bonds and lock in a guaranteed loss. I mean, it's hello, what are you thinking to do that? And so I suspect that is why we are seeing the big moves, the move higher in interest rates, and in particular on these shorter term bills and notes. It's just investors are not willing to lock in a loss on an investment. Why would you? Pay attention to inflation, pay attention to the equity markets. If you don't have as much physical silver as you want in your portfolio, go get it now. The spot price yesterday was $22.51. Looks like this morning it's $22.56. I bought what I get yesterday. I got junk silver and 1 ounce rounds yesterday, and I paid, I don't know, I think I paid a $5 premium, somewhere in there. It's like I really don't care at this point about premium. I'm focused on putting into my portfolio the physical silver that I intend to hold, and I suggest that you do the same. So if you got a hang up about premium, I suggest that you get over that. Oh, and on the note of premium, so we are at a full 12 months now where premiums in the precious metals have remained elevated. According to Franklin Sanders, what typically happens years past, premiums get elevated from time to time, and in no more than 4 or 5 months, those elevated premiums drop back to the norm, basically the background level. And in that scenario, when the precious metals markets are behaving that way, it doesn't make any sense to pay a premium for premium. When premiums are elevated, it might not make sense to go buy physical silver, wait for the elevated premiums to drop. Well, here we are, 12 months, elevated premiums have not dropped. Famous last words in the financial markets are to say, this time is different. But I would suggest that this time is different. Somehow, some reason, there is something different going on in the physical precious metals markets, or the premiums would not remain elevated 12 months later. So I'm going to leave you with that, folks. Ran a little bit long this morning. Have a fantastic day. Take care of your finances. I'll talk to you soon.